All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. 1st of May. Let's kick off May here and our 30 days, 30 indicators series. Over the course of the month, we are going to go out and look at 30 technical indicators. I realize there are not 30 days in the market that are open during the month of May, but we're still going to pound out 30 indicators that we're going to look at. We're going to take a look at how it's calculated, what the story is behind it, how it is used, and I'll show you some variations to some of the indicators that I use and kind of what I'm looking for when I go and look at these indicators. I'm going to assume that the audience that I'm speaking to has very little experience when it comes to technical indicators in the market. Now, I know that's not the case, right? In fact, most of you, the sound of my voice, you know what technical indicators are. You understand how they work. You've used them a lot. But going to take a much more basic type of approach in a simplicity approach, because when it comes to technical analysis and technical indicators in the market, simplicity is what matters. When we go and we look at technical indicators are not about, well, should I buy or sell? They're not about, well, is the stock going to go up or down tomorrow? They're about a story. What is the story? When it comes to technical indicators, this is what we need to answer. Now, with this story, we can understand if the odds are in our favor to go higher or lower. We can understand time frames. We can understand key levels. We can understand a lot about the way the stock trades, and we can put the odds and the probabilities in our favor. But it comes down to what is the story with the technical indicators. And there really are 3 indicator types. Maybe a 4th one, and we'll go look at those a little bit later on in this series. But most indicators fall under one of these 3 types: momentum, oscillation, or volume. They're either showing trend, oscillation, which is overbought, oversold, high, low, or a volume, market participation, trader participation. Are they jumping into this stock? Some indicators are mixes of multiple stories here, or multiple types. We can have an indicator that's a momentum indicator and has an oscillation component to it. We can have a volume indicator that's an oscillation, indicator as well, right? But today, I want to go out and start with, perhaps one of my favorite indicators. And it is a very simple indicator, and it's one of the oldest technical indicators that's out there, and it is the stochastics. The stochastics was developed by a gentleman named George Lane back in the 50s, and he was a big proponent of a concept that price action in stocks or price action in the market follows momentum of price changes. So if you can see where momentum is changing, you can see what the future price action is going to be. So he created an indicator for this concept, right? And you hear me using the term momentum, right? Now, the stochastics, momentum and oscillation, depending on how you use it, but here is the calculation. The formula for the stochastics oscillator is the %K, which when we deal with the stochastics, we're going to have 2 terms, %K and %D. But the calculation is the close, stock price close minus the 14-day low. So what's today's close minus the 14-day low, divided by the range of the last 14 days. So the high, 14-day high minus the 14-day low, and times by 100. Very simple. Really simple. What's it telling us? It's simply telling us whether the stock price is high or low relative to the last 14 days. That's it. Is the stock price high or low relative to the past 14 days? And this is the %K. Now the %D, right, which we're going to see in the stochastics, all it is a 3-day moving average of the %K. So let's go take a look at what that looks like. Here, we'll just use Caterpillar. And I'm going to come down here to indicators, and we're going to add on the fast stochastics. Okay? You're going to notice the parameters here, 14 and 3. These are the original George Lane parameters. We can alter these. We can take and go 28. We could go any number that we desire here with it. But let's start out with George Lane's intention, 14 and 3. And you'll notice we'll get 2 lines here, black and a red line. The black line is the %K. The red line, you notice how the red line's a little bit smoother? That's just a 3-day moving average of the %K. So it's always going to be smoother. %D is always going to be smoother when it comes down to it. Overall, this is a pretty herky-jerky indicator. Right? I mean, it's got a lot of highs and lows and everything like that. But bottom line is above 50, momentum is positive or bullish. Below minus 20 or below 20, momentum's very negative. And above 80, momentum's very positive. Some people will use the term overbought above 80. And oversold below 20. Now, I caution you, overbought does not equal have to go down, and oversold does not equal have to go up. In fact, in many cases, oversold stocks, like right back here in October, oversold stocks go down. Okay? But what George Lane wants from this indicator is to see when there's a change going on. When is the momentum changing, right? When is the momentum going from this oversold period or this bearish period into a bullish period? When is it emerging from below 20 to above 20? Vice versa, when is it going from an overbought period to, hey, you know what? Sellers are starting to come in and starts to push below 80. Now, if we're just kind of looking at this indicator and trying to read the story, today's action, does it tell us anything? You know, it tells us that the stock price is kind of right in the middle of its range for the last 14 days. And, the indicator is simply going to just follow the stock price, right? It's just gonna kind of reflect what the stock price is doing. And so George Lane took it out a little bit further, and he developed what's called the slow stochastics. And I'm going to put this on and take a look at the difference between these two indicators. The slow stochastics looks a lot smoother, right? A lot less herky-jerky. All the slow stochastics does is it takes the %D from the fast stochastics, right? Takes the %D and turns it into the %K on the slow stochastics. They're the exact same number. You'll notice the %D on the fast stochastics, 45.82 right now. The %K on the slow stochastics is 45.82. And then they calculate a %D, which is what? A 3-day moving average of this %K in the slow stochastics. So we kind of have this smoothing mechanism that is going on here with the slow stochastics. So it's a little easier to use, gives pretty much the same information, but a little easier on the eye, a little less herky-jerky there with it. Okay. So we're gonna take off the fast stochastics, right? We're just gonna use the slow stochastics. But I want to come in here and I want to change up the time period here for you so you can see how it looks. What do we change if we change the time period? So let's go 28 and 3. We'll just double the time period there. Well, they look exactly the same. Let's see here. That is not coming in correctly. Let's see if they'll get it right this time. There we go. All right. Do you notice any difference here? Look at the difference in something like this or something like this. Basically, what happens is the longer the time period we go, the more days we give the stochastics, the smoother it's going to be. The more accurate some of the reads are going to be, but also the reads are going to be a little more laggy, meaning they're not going to be as instant, they're not going to be as quick. So you give up a little bit of accuracy for timing, or give up a little timing for accuracy. And for each trader, it comes down to how they prefer, to use it. On every one of my charts that I look at, on my base chart, I always have a stochastics. Not the 28-day, just the regular 14-day. Just have a stochastics on. And you say, well, what story am I trying to pull from it? I'm not trying to pull a story. Most days I look at it like for Caterpillar right here, and I just go next. It doesn't tell me a darn thing. Gives me absolutely nothing, and that's fine. But from time to time, it does give something. Now, some people will say, well, with the stochastics, all you do is you buy when the black line crosses above the red line, and you sell when the black line goes below the red line. They use the crossovers of the %K and the %D. I don't understand what sense that makes. And if you've ever tried it or go out and try it, you buy when you get the crossover, you sell when you get the crossover, you're going to get a lot of whipsaws. Occasionally, yeah, it'll work, like back here in May. It'll work nicely. But for the most part, you're going to see a lot of whipsaws. So I don't subscribe to that, right? But George Lane talked about, this indicator being a indicator to look at speed and momentum of price. And so we want to see when momentum is shifting, when momentum is changing. How do we see that, right? How do we come in and go, well, you know what? We do have some momentum changing. Let's just come in here to 1 stochastics, to the 14.3. And let's take a look right here in March. We have the stochastics goes from up here to down here. It comes into minus 20 and then starts to rise. Okay, we've seen that many times. That's not necessarily telling us anything crazy, right? But then it pulls on back again, and notice how it makes a higher low. And then we get that next kind of thrust higher. When we see some action like this, what do we know? We know the momentum in the stock is changing. Same thing is right up here. We get all the way up here above 80. We push on down. We rally again, a lower high, and then we break this kind of midpoint. We start to push into a little bit of a lower low. What do we know? We know momentum of the price is changing. Let's just scroll up and see what the stock price did during these times. During this time right here, stock price was pretty flat, right? Stock didn't really go anywhere. Momentum changing? Absolutely. Momentum changing. And then boom, there we go. $12 higher in the next little while, right? Stochastics showed a momentum shift before the price action took off. Then we get this downside momentum shift, right? Right here we get confirmation that, all right, price action's changing. This upside, done. Price action is shifted. Now, there hasn't been massive follow-through to this one, at least not yet, right? But a time where, okay, price action is being altered. When you have something like a higher high, like right here, that's not showing a price action shift. But when you have a higher or lower high, Yeah, we have a price action shift, right? The momentum in the stock is changing and suggests that there's further action to come. That's it. You'll notice this doesn't happen every day. We see in this chart we get 1, 2, 3, 4 times where we get this higher high or higher, or this, a higher low or lower high element. Only 4 times in what, almost a year? Right? A little longer than a year and 2 months. It doesn't happen very often, but when it happens, it's very telling. But this isn't why I have the stochastics on my chart. I have the stochastics on my chart for one reason and one reason only. And it's very voodoo-esque. It's not something that I really have a great explanation for or an ability to say, hey, you know what, this is why it happens. But when we see the stochastics roll off of 80, like right here, the stock almost always goes down. Not 81, not 82, not 78, not 76, 80. It almost always goes down. When the stochastics rolls off of 20, which we don't have here, we don't have an exact kind of roll off of 20, this kind of dip down and just pop off of 20, the stock almost always goes up. It doesn't happen very often, but when it happens, it's incredibly accurate and really nice for some short-term trades. A lot of the weekly options that I will trade are based on this. So if I have a stock on my watch list, I'll just kind of go through. I'm not scanning for this or, going, okay, let me see if I go find this out there in the market. I'm just going through my individual stocks and, okay, if I see it, then I'm willing to play it. Right, here's Visa. Right off of 20, boom, the next 7 days, big upside, right? You'll notice it just doesn't happen very often off of 80 or off of 20. It just doesn't happen all that often, but when it happens, it's incredibly accurate and incredibly fun to play because generally the move is very quick. And that is why I use the stochastics. I don't really use it for a heck of a whole lot more in this view. Okay. Why? Because I think the momentum story that the stochastics tells with the 14 and 3 is too herky-jerky. It's too wild. There's too many swings associated here with it. And there tends to be a lot of whipsaws. And that's not very fun. My favorite view when it comes to the stochastics is this parameter of 39 and 1. 39 days, and the 1 just saying, hey, we don't need a moving average. We don't need a percent D. Right? All we need is the percent K. That's it. Why 39 days? Seems like a funny number. Well, 39 days was made famous by John Murphy. In a lot of technical analysis that he did and he uses, 39 days is what he incorporates. 39 days is a longer look. It's a longer period of time. But it's where we start to see major shifts in momentum. When the stochastics 39.1 pushes above 50, we tend to see a pretty positive change in momentum for a sustained period of time. It doesn't mean the stock goes up every day afterwards, but we see sustained upside momentum for a while. When it moves below 50, we tend to see sustained downside momentum for a while. Now, you'll notice in this case, no, not always, right? In fact, it comes down, it whipsaws, gives another, upside momentum, and the stock, carries on higher. Then it breaks down below 50 right here. Downside momentum to follow. Breaks up above 50. We get a day or two of upside. Breaks down below 50. Big downside momentum to follow. Breaks back above 50. Upside momentum to follow. Breaks down below 50. And, we see it's on the downslope here. It's not something to say, well, I'm just going to buy it when it goes above 50 or sell it when it goes below 50. But it does a really good job of telling you what the likelihood of the next trend is or the momentum over the next 6 to 8 weeks. It does a fantastic job of it, and it is my favorite use of the stochastics. I've played with it. I've used it for other areas, 80 and 20, and it's going below 20 or above 80 or, things like that. And, it works from time to time, but in and of itself, it's not all that great. But when I want to understand what the momentum story in the stock is going to be over the next 6 to 8 weeks, the Stochastics 39.1 is a fantastic indicator for that. I don't use it as a trigger. I don't use it as something to say, hey, I'm going to go buy it when it moves above or below 50. But every weekend I go through my watch list and I understand. Okay, you know what? This stock's now above, this stock's now below. Okay, and I'm going to look for upside signals when it's above. I'm going to look for downside signals when it's below. I'm not going to use it as signals, but I'm going to use it to understand what the momentum is most likely to be. And then I can add a signal indicator here to it. So that's the stochastics, right? It's a pretty simple indicator. We have the %K, we have the %D, we have the fast stochastics, the slow stochastics, and you can alter it and change it, a little bit here. We have this kind of voodoo element of rolls off 20, rolls off 80 for some real kind of short-term fun trades. And then we have this kind of 39.1 element that is really good for just understanding the momentum of the stock that is most probable over the next 6 to 8 weeks. And so a lot of different uses here for it. Very simple indicator, one of the oldest indicators out there, and it's still in use today, and that tells you a lot, right? Now, there's very sophisticated variations to this indicator. Yeah, there are. But as you go in and you kind of hone in and you get more and more sophisticated with the indicator, you don't necessarily see a change in tendencies, change in story, change in the way that it works. And so it doesn't really help. The indicator was developed with simplicity. It's meant for simplicity, and it tells a very simplistic momentum story here with the slow stochastics. Some people call this an oscillator. They use it for oscillation, highs and lows, ups and downs. And if you're day trading, if you're really short-term trading, yeah, there's a way to use it. I don't really like it. I think there are better indicators. But this is not an oscillator. This is not a good oscillator. Even though many use it as such, it wasn't developed by George Lane to be an oscillator, and it doesn't work very well as an oscillator. If you're selling the stock when the oscillator gets overbought, generally you're missing out on most of the run. And if you're buying the stock when it's oversold, generally you're going to have to ride a lot of downside before you get that upside reversal. But that's the stochastics. Fantastic indicator. If there's one indicator to start with as a new trader, stochastics is a great place to start. It's a great place to start because of its simplicity, because of its story, and because you're not getting new readings every hour, every minute, every day, right? This is something that, you're seeing the momentum shifts over time, and you get about 3, 4, 5 of those a year when it comes to your stock, and when you do get them, they tend to be very strong. There are quite a few right now in the market that have some, shifts. UPS has been in this kind of bullish momentum, has pushed into a bearish momentum phase, right? We had Caterpillar on earlier. Here's Caterpillar with the 39.1. It's still in this bullish phase on the oscillator. You can see it changing to bearish. It wouldn't take much, but still in the bullish phase. Hasn't changed its stripes here just yet. Something like an FCX changed last week, right? It's been in this nice bullish phase, changed last week. An Alcoa, it's been in this bearish phase now for a few weeks. And while, yes, it's had bounces, it continues path of least resistance lower. You take a stock like Apple, right? It's been in a bullish phase since back here at the beginning of February, right? And the Stochastics 39.1 has stayed above 50, and Apple has remained very bullish here during that time period. You take a look at Visa. This shifted here in January, and it's remained bullish, since that time period. And so just one of the best momentum oscillators or momentum indicators that is out there in the market, and that is the Stochastics. Thanks for hopping on. Any questions, please let me know, and we'll talk to you later. Take care.